Hi everyone, my name is Stangwa and I'm from Team Easy. Welcome to this webinar where we'll be talking about picking stocks and what to look for in the markets. I'm joined today by Higgo van Biljon. He is the CEO and founder of FinMeUp, which is a mobile app based on financial education. And I also have Barry Dumas, who is my colleague and head of Easy Research, as well as he's a market commentator and contributes to our sister company, GT247.com. Gentlemen, how are you?
I'm good, thanks.
Hi guys.
It's great being here. Thanks.
You guys have unique names. Higgo, I don't speak Afrikaans, but the Van Billion in your name, does that have to do with money?
No, I wish it would have been cool, maybe like fun billionaire, but no, not even close. It's just a normal, ordinary surname.
Okay, cool. And Barry goes by the Beef. Barry goes by the Beef, and I'd like to understand what that nickname is about, Beef.
Yo, Stano, I don't think this is a PG, or is it a PG show? Maybe. But no, it's just a nickname that was given to me by friends at a festival many moons ago, and yeah, it kind of stuck. So when I did my Twitter handle, I kind of thought I would have like a beef with markets, got a score to settle there. So yeah, it stuck.
Nice. All right, let's get straight into it then. Gents, this is pretty much a chat about investing and how to get started, right? And the kind of things you need to look out for. So let's say you are a newbie on the EasyEquities platform and you're not sure exactly what to invest in and where to start looking. So put yourself in their shoes. And I want to start with Higgo. So Higgo, say you're a new, so you're speaking to a friend who's new on the platform. What would you say is how would you tell them to start? Where must they look and what do they have to look out for?
Yeah. Okay. So I think the best thing is to just start. So the nice thing about EasyEquities is the demo platform. And I know some of my friends that I've referred to that never started investing before. I know some of them first tried out the demo platform, tried to understand it a bit better. But what I also realized is that you can also just start by investing a very small amount, even if it's just 10 Rand, to just get some more interest in a company, because it will just automatically help you find more interest in that company and actually give you an incentive to research the company. Then when you actually want to go further, then you should actually do the research. So what I usually do is I just go onto the website first of the company I'm researching, go through all the different aspects of the business. So the about us, the vision, the management, the industry, the financials, so you can go from very simplistic to very complex with the financials, for example. So the best is to just understand the company as best as you can. So try to put yourself in the customer shoes of the company. So for example, if we take Apple, we all know Apple, we all use, well, a lot of people use iPhones, and it helps you to understand the product better. And when you use the product yourself, for example, Apple, then you know about the App Store and you know about the services, Apple Music. So it helps you to understand. So if you can do that with different companies, it can help any investor to understand what they're investing in, as that is the most important aspect. But there's so many resources for beginner to experts in investing. So the most important aspect, I'd say, is just buy your first share or invest in your first share and find interest in what you're investing in and go and understand that company.
Hundreds. Okay, so it's almost like one of our old mottos was investing in the brands you love. So if you have a particular interest in a specific company or sector, start investigating the inner workings of it and it will take you, as I understand it. Fantastic. Okay, cool. And so a lot of analysts like to talk about fundamental analysis and technical analysis. And I'd like Barry to sort of just like introduce to us what fundamental and technical analysis, since you touched on it, Higgo, when you're talking about looking at a company's financials. So Barry, if you can start us off on what fundamental analysis is.
Okay, cool. So basically, there are a lot of analytical kind of styles of investing, right? Which is fundamental is basically the most popular one nowadays, or since existence of investing. But basically what fundamental analysis is to analyze the health of a company. So you look at the company's balance sheet, you look at their earnings, their future growth potential, and you kind of take it from there. Some of the information is very technical, but yeah, so basically it's just analyzing the health of a company and making an investment decision based on that information that you receive. Yeah.
Right. And fundamental, does it sort of include like what future plans the company has? Is it just always purely technical about numbers, or do they actually go into like the summary of the company and where it's headed?
Yeah, they usually do. They give like a future forecast or a growth forecast for the year or the coming quarter. So that's kind of what they estimate what the company's growth potential is over the period that they stipulate. So yeah, so they definitely do it. There's a lot of things going on within companies themselves, like insider buying, insider selling, all of those kinds of things, which also gives the investor a clue of what is actually going on within that company. So yeah, there are a lot of things that are not necessarily related to numbers.
Fantastic. And then if you can just briefly also introduce technical analysis, what is that all about?
Yeah, so technical analysis, I think the misconception about technical analysis is just about charts and chart patterns and a lot of hocus pocus. But nowadays, you'll find a lot of big asset managers combine both aspects, a fundamental and a technical approach, because technical analysis look at different things than fundamental. So technical will look at sentiment, will look at the options market, a lot of things that the fundamental side doesn't look at. And then at the end of the day, they'll go to a chart and say, okay, great, these are awesome entry levels, exit levels, the fundamental support, the technical outlook, let's go for it. But yeah, technical analysis is much more than just looking at a chart. So basically, you'll go and look at a chart at the final step before you start investing.
Makes sense. So then will you tell me then, which one do you personally prefer? What's your starting point when it comes to this kind of analysis?
Well, like I suppose everyone should grow their investment journey and grow how they pick stocks. So basically, I started off by only using technical analysis. And that was just looking at charts. I didn't even understand what the hell I was looking at. But I kind of read a lot about it. And yeah, and at the end of the day, it really didn't make that much sense because it didn't paint a holistic picture. So then I started delving into fundamentals as well. So I kind of use both. So fundamental analysis, I'll get the overall picture of a company. Okay, am I interested? Am I not interested? Then I'll go to the technical aspects. I'll look at what the options markets are doing. Are guys short selling the stock? Are they buying the stock? Are there a lot of open interest in the market? Yeah, so nowadays I use both. And then you have another thing like quantitative as well that's coming in now where computers and algorithms do most of the work. But that's our topic on its own.
The whole other topic, that's correct.
Yeah.
And Higgo, do you have a specific kind of style, whether it's fundamental or technical, that you prefer?
Yeah, so I definitely use way more fundamental. First of all, I think technical is a bit too high up for me to understand it completely because I really like to understand what I'm investing in. So that's why fundamental is so much more attractive for me because I can understand the company better. And when I can understand the company better on the fundamentals, I get a better picture of where it's going in the future. So I'm more a long-term investor. So when I invest in a company, I really want to understand where they're going and will they in 10 years be way bigger than they are now. For example, Tesla. So a lot of people know I'm a big fan of Tesla. I started buying at $300 pre-split. And the reason for that is so a lot of people argue they are extremely overvalued at the moment. But if you look at the entire business, so people say it's a vehicle manufacturer, they're the biggest vehicle manufacturing company in the world. They don't deserve it, or they're not the biggest. Actually, all of that rubbish, in my opinion. But they are actually a technology business. So the way Apple monetized the phone, I believe Tesla can do with vehicles. So, for example, they don't just sell vehicles. They sell, with the vehicles, they sell insurance. They sell the autonomous vehicles that are coming now, which would lead to an autonomous taxi service, which would take on Uber. Then they've got the solar panels. They've got the infotainment, which can later become their own very Netflix in the autonomous vehicles, or the Netflix for games. So there's just so much potential, and I understand that fundamentals where they want to go. And then you should just ask yourself, do you have the faith in the management to execute this? And if you look at Elon Musk's history, sure, he's not like every ordinary CEO, but he gets things done and he executes it well. And that's why I prefer fundamental analysis with all companies, looking for 5 years plus. What are they doing now? What's their history? Have they shown that they can execute? What are they doing now? And what are the plans going forward? And then I invest in the future growth. So I'm more a growth stock investor based on fundamentals for the future.
Now, you mentioned Tesla. So I'd like to just reiterate that at this point in the webinar, that we are not necessarily giving advice or telling our clients and people watching this what to invest in, but rather giving people a guide as to how we look at things. And how we look at things is through the lens of different kinds of analysis. And no one here is a prophet. We only base everything on information we get publicly. So everyone can actually go and research this stuff and find out, because all this information is made public. They are publicly listed companies. And so I have a question here by someone asking, by Tato actually. He is saying that you guys mentioned technical and financial analysis for company X, and where can one find the best platform to research this? So I'll give this to Barry.
So yeah, there are various websites and platforms that you can use. Obviously, FinMeUp is one very cool one as well that you guys should check out. But majorly, if you're interested in looking at local JSE stocks, then you can go on to platforms like MoneyWeb. Well, that's besides Easy Research, but you can go on to MoneyWeb. For local stocks. For international stocks, I primarily use a platform called Seeking Alpha. So that's for US stocks. They give you everything that you need to know on a fundamental basis about US listed stocks. So you can get everything there, from dividends to earning releases, earnings, everything that you want. So that's a good starting point for new guys.
And I've seen on your research notes, Barry, that you do actually list your sources at the bottom as well. So yes, people can go out and check Easy Research, where Barry does his hustle and he puts it together, and you can see also the resources that he gets a lot of information from.
So, can I actually throw a curveball in also for research, where you can find information? Yeah. So one of the best resources, in my opinion, is actually YouTube. There are so many amazing YouTubers that cover various aspects, whether it's fundamental or technical analysis. And that is also one of my actually approaches to understand companies, looking at a lot of YouTube videos. But also, if you look at the companies that had a great year so far, like Tesla, like Square, and so on, you'll see so many YouTubers cover those companies. And what's nice about that is, there's a new company called Lemonade that listed recently. They are to do with insurance. And now also a lot of YouTubers are covering those stocks. So first of all, you can understand the companies better by just looking at all the research on YouTube. But you can also then get a better grip on the demand, because every time a YouTuber speaks about Tesla or Square's Cash App or Lemonade's insurance, it's free advertising for those companies. So millennials that are constantly on YouTube, looking to learn on YouTube or find interesting stuff on YouTube, is free advertising for those companies. And I think YouTube is also actually a great way to start.
That's a great point, actually. Yeah, actually a great point, because I also use YouTube, but I get a lot of insights on businesses from CNBC. They give snippets of different businesses and how they're doing, and even sometimes in South African context. So that's actually a great one. Okay, cool. But now I want to go back to being personal. What are your guys' favorite or preferred indicators for investments? And that's not necessarily a technical indicator, which is that chart stuff, which is complicated names, but just an indicator for when you're like, okay, this company might be something I'm looking at. And of course, people say one indicator is never a good enough place to look at, but I'll just like to check, cheeky, if you guys have a specific favorite one. And I'll start with Higgo.
Okay, sure. So definitely a big thing for me is the insiders holding in the company. So, I mean, if the CEO or the management only has a very, very small portion of the company, it doesn't really give me confidence that the company or that the management believes in the company's long-term prospects. So when an insider is buying or when an insider owns a lot of shares in the company, especially if the CEO is the founder, because he understands the vision from the start. He understands the fundamentals. He understands the business completely. So I'd say management is a very big aspect.
Sweet. And you, Barry?
Yeah, I totally agree. I also like the insider buying, insider selling within the financial organization. That gives you a very good heads up of what's going on. But for me, there are so many, really. There are like literally so many indicators that you can look at. And one that I usually love seeing is a sentiment driver, and that's usually called the herd mentality. So you'll get people just jumping on the back of a stock for no reason besides there's hype around it, popularity is driving it higher. And that's awesome to see the psychology within the market and market participants themselves. So for short-term win, those are always nice to have and nice to see. Yeah, so I kind of look at that quite a bit, or look for those quite a bit. But that will fall more into short-term, not really necessarily investing. But in the bigger scope of investing, then that is a very good sentiment driver. You want to see that influx of interest buying within a share, which will probably kickstart it to go and reach new heights, right? The other thing that also is very topical lately is when you see like topical events happening. So say, for instance, when there was this interest in gold reached new highs recently and everyone was excited, everyone was jumping on board, everyone's buying gold. So that's a very good indicator for our easy investors is what stocks will get affected by gold. And you saw that on the JSE, a lot of gold stocks were booming. So that's a very easy way of finding good opportunities within stocks that you probably already own. So yeah, that's the kind of the things that I look at. It was very topical this year as well.
Okay, sweet, nice. And then so sticking with a slightly more personal question, I want to ask you, Barry, starting with you, is what has been like your biggest or your favorite win in the markets?
My favorite win?
Yeah, where you were just like, yeah, I outdid myself here.
Yes, there are so many. No, I'm just kidding. But there are two actually. So at the start of the year, it was Tesla. Yes, that one was a lucky one. That was a good win. Then I sold out of that when the hype died down, and I never rebought it again when this last run happened. So I was kicking myself for that one. But I took that cash and invested into Apple, which is a very good, solid long-term stock for myself. So I'm very happy with that one. And Apple has been a good stock in my portfolio. So I'll stick with Apple.
Nice. And Higgo, what has been your favorite win?
So most people would say it's Tesla, but it's actually not. It's NVIDIA. And so I bought NVIDIA in, I think it was 2014 or 2015 at $36. And then it recently ran up to $580. But I'm still invested. This is still a long-term play for me, so I'll still hold it for 5+ years. So I'd say that was my best investment, and yeah.
And why did you pick NVIDIA back in 2014, you said?
It was purely based on, I saw this management knows what they are doing, and the products that they had was definitely for the future. So whether it's artificial intelligence or the chips that they make, or the gaming world. So they are in all these industries and sectors that I knew back then and still know for the future is industries that will blossom. That's why I'm not selling it, because the fundamentals have not changed at all. So I only sell companies when the fundamentals change. So because I'm a long-term investor, the current valuations don't really bother me most of the time, as it's a long-term play.
Sweet. And then can I ask you, Higgo, what has been your biggest lost opportunity?
Selling Steinhoff. I remember I started buying Steinhoff when it was about 26 Rand a few years back. And then it just went to 35 Rand, 40 Rand, 46 Rand. And I just kept on adding shares. And when it was 90 Rand, the news started coming out of the fraud and everything. And I should have just sold immediately, but I thought, maybe it's just whatever. And I think it was a bit of greed, but so we learn. But I mean, it's not something you can predict. Fraud is definitely, you can't, as an outside investor, necessarily know all the details of the company like fraud. But I'd say I should have just sold my Steinhoff and missed opportunity. There's so many not buying early enough or not buying enough of some companies, but you can't always get it right. And so you learn.
And speaking of Steinhoff, as a result of Steinhoff, we, not as a result, but right after Steinhoff happened, we ended up creating a feature or had a feature on our Easy platform called Offshore, which protects investors from events like management fraud. So when something like that happens, investors would be protected, and it's an insurance on your stocks, one of a kind. So I just wanted to say that. And Beef, what would you say was your biggest lost opportunity?
Oh, Stanwell, there are so many, man. Yeah, it's very difficult to say. There are obviously a lot of companies, a lot of news happening this year. So in a lost opportunity in the sense of not making money or not investing, there were also a lot happening this year.
Yeah.
I think when the bottom hit at like mid-March in the markets, I think Sasol was a very good buying opportunity. But there was a lot happening with that company as well. And it increased quite a bit from the March lows. But yeah, man, there are so many. And like you said, that's how you learn, You're going to miss some, you're going to make some, and that's part of the investment journey.
Yeah, no, I feel you. My biggest lost opportunity was Tesla. I had a friend for the past 3 years who was just going on about Tesla, and I just never invested in it. And look at it now. So
yeah,
it's never too late.
It's never too late, Standwa. Never too late.
And so when it comes to this, I want to speak to. Actually, I do have a question from someone here. They're asking, so they're a newbie on the platform. And they want to understand like sort of the overall process of how it works. So let's say you identified Tesla as a company to invest in, and I'll take this to Higgo. Let's say you've identified Tesla, and do you just always monitor their growth? And also, when do you decide to sell your shares?
Okay, so like I said just now, I only sell when fundamentals change, or when I'm probably going to one day decide, okay, enough is enough. I'm just going to sell all my stocks and retire, which is probably not going to happen. But for a company like Tesla, the best is before you invest, don't just buy if someone else says buy, or don't just buy if people are buying. You should understand yourself what you're investing in. So do as much research as you can. And like I said, YouTube is an easy way. The app FinMeUp's stock picks is also a good way to find new companies and see the research on them. But once you understand the company and you really like what you're seeing, you should understand why you are investing. Are you investing for a quick trade, or are you investing for the long term? And if you're investing for the long term and the fundamentals don't change, then why would you sell? For example, so just taking Tesla as the example now. Recently, Tesla's share price skyrocketed the past year, and it came back now the past week, a significant pullback post-split. The reason for the pullback was mainly three reasons. The first one was they didn't get included in the S&P 500. So people was like, why did they not get included? I'm selling my shares. So I'm panic selling. The share price dropped. The second reason was hedge funds. And funds had to sell some of the Tesla shares due to regulation. For example, ARK Invest, that's always said that the biggest holding in their portfolio is Tesla. They had to sell because Tesla grew so rapidly to get Tesla below the 10% mark in their portfolio. So there was a lot of forced selling, and it led to the decrease in Tesla share price. Now, personally, I bought Tesla from the start for 2030. You know, I don't care what's happening in recent news. So any significant pullbacks will see me adding more. That's why I think it was 2 days ago when Tesla fell 20%. Everybody, I was just getting a lot of WhatsApp Teslas. What's going on? I just bought more because I'm not saying that's what you should do. This is just what I'm doing. And I understand why I'm investing. And I think this is with any company. Try to ignore the headlines and just make your own headlines. Do your own research, look into the news yourself and make your own understanding of what's going on, and ask yourself, did the fundamentals change or did something change for the reason why I invested in the first place? And then you stick with your vision.
Sweet. And actually, I'm glad that you touched on the reading the news and understanding what's happening instead of just panicking. And so,
Yeah, definitely.
Exactly. And speaking of panic, like, can you guys speak to like emotion when it comes to your money? Like, how do you build that tolerance to just avoid all of the noise, Higgo? Like, how do you just say whatever?
Yeah, emotional decisions can really damage everything. I've done it before, and I learned a lot of lessons by selling just because, people are selling or reading the headlines, and then straight after I sell, the share price goes up. Or even in business, when you make emotional decisions. So as I started, I've always enjoyed starting companies and building it, and now fin me up. And there's always difficult challenges, and once you get emotional and make decisions while you're emotional, it can really end badly. So the best is to just, I'd say, when you get emotional about a share or a company or business or anything, just take 2 days. What's going to happen in 2 days? Just think it through before you just press that sell button or press that buy button, and just take a step back and breathe and tackle it again later.
Nice. Barry, did you have something to add to that?
Yeah, definitely. I mean, emotional selling is definitely a no-go. But yeah, and I used to struggle that a lot in the beginning. But through the years, I've started upskilling myself, definitely reading a lot about market psychology, getting to know why people buy stocks, why people sell, why there is a herd mentality, and so forth. So that helped me quite a bit. And the one thing that he mentioned now was the headlines. So the one thing within market psychology, one thing that you'll come across is contrary indicators. So a headline is a very good example. So if headlines start appearing everywhere about a stock, say for instance Tesla, oh my word, it's the end of the world, blah 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 blah, that is a good indication for you to either start buying more stock, or in the reverse, if it's starting to go too well, do you start maybe selling that company? So market psychology is very interesting to me, and I love the topic, and it's helped me quite a bit. So for all the newbies out there that struggle with emotions, get into that.
Oh, nice. And also a big thing about getting emotions out is for you to mitigate risk, right? And so one way to mitigate your risk, as I said before, is that we've got a feature on EasyEquities called Offshore, which protects you from internal issues that will arise in a company's management, like a Steinhoff. But in the event that there isn't necessarily a Steinhoff and you don't want your emotions to impact your portfolio, diversification is something that people love to punt. And so Higgo, I was wondering if you could speak more to diversification. What are your thoughts on diversification?
Okay. Yeah, sure. So obviously, the more you are diversified, the less the risk. But also, the more you are diversified, the less growth you can expect. Because if you just buy the market, you're probably going to end up doing well. And as Warren Buffett also says, if you just buy an S&P 500 ETF and you just buy it and leave it, you're probably going to outperform a lot of fund managers. But personally, I'd say 7 to 10 stocks. So I made a rule for myself in every country that I invest in. So, for example, the US stocks, I'm not allowed to have more than 10 shares. For JSE stocks, I'm not allowed to have more than 10 stocks. Actually, in my current portfolio, I only own 3 JSE stocks. In my US portfolio, I own 9 stocks. The reason for that is I don't want to over diversify, as it can really, first of all, it's difficult to understand 40 companies if you invest in 40 companies. And I really want to understand what I'm investing in. So that's the first part. And second of all, if you really focus on a few companies, you'll understand it better. And if you really believe in those companies, then you're going to end up doing better than if you just buy 40 companies. But if you only buy 3 companies, you're definitely risking a lot, because who knows what can happen tomorrow? Nobody knows. That's why diversification is key, but over diversification, in my opinion, can also be not the best investment.
And Barry, what do you think of this diversification, over and under? What do you think?
Yes, that's a very cool thing, man. Yeah, sometimes very difficult to pull off, but a very good tool in your toolbox if you can. So for newbies who don't necessarily know the mechanics of the market yet, a good starting point would be getting into ETFs. They kind of do all the legwork for you up front, and you're off to the races. But yeah, you'll definitely have to have a good combination of splits within your portfolio. So maybe 70% equities. You can even use bonds in cash. All of those things are to your disposal to try and diversify your portfolio. But it's not necessarily as easy as we always make it out to be. But yeah, you have to.
And speaking of ETFs, you guys have mentioned ETFs. I just want to say ETF stands for Exchange Traded Fund. But I'm hoping, Barry, you can sort of speak to ETFs and just break it down for the people a little bit more. Like, what is an ETF and why is it attractive and valuable to investors?
It's a very cool asset class especially for new entrants to the market who don't necessarily know anything about fundamentals or technical. And they don't have the time to do the legwork to delving into those financial basic little basket of stocks that track an index, or it can be.
I think Barry is just cutting off a little bit there, or is it just me?
Yeah, no.
Anything that you kind of want it to be, way that it tracks in the S&P 500.
A little bit.
Cutting off.
You were just cutting off a little bit. Sorry about that, man.
No stress, man. Where was I? Where did you miss?
Pretty much everything. Can you start from
Everything.
the top?
Okay, cool. So yeah, so ETFs definitely the place to go for guys starting out. So basically, an ETF is a little basket that tracks an index. So newbies or easy investors don't necessarily have to go and delve into the financials of those stocks within that little basket. The ETF does all the legwork for them up front. So it's a very easy way of getting exposure within the market, and you don't necessarily have to go and buy those stocks on an individual basis. So yeah, ETFs, very cost effective, very cool way to diversify portfolio as well.
Yeah, and if I can also expand on that. So what happens with an ETF for people who are just joining us is that it's pretty much a collection, as Barry said, or basket of stocks, but it's created by financial institutions mostly, if I'm correct.
Yeah.
And they're listed on different exchanges like the JSE and New York Stock Exchange. and it's pretty much these baskets are either based on indexes or indices or themes. So for instance, we found tech themed ETFs where you can buy maybe the top 500 tech companies, or a new one that just got launched now by Satrix is the ESG ETF, which is based on environmental, social, and governance good practice. So there's different themes for ETFs, and it's based on what you're kind of interested in, and it already is diversified. So ETFs are fantastic. And another thing I'm going to plug is we've got a resource for everything you want to know about locally listed ETFs, and that's EasyETFs. So make sure to check it out. It's got all the information you would need, and you can compare the different ETFs to one another. But yeah, so that's pretty much it on ETFs. And someone mentioned here and in my notes that ETFs might be a good idea as a building block. And so next week, Thursday, I just want to plug that we've got an ETF webinar happening featuring our Easy ETF guru, Sean Keeling, and Fabian Makwerere from Intellidex. And they're going to be talking about different strategies and how you can use ETFs in building your portfolio. So check that out next week, guys, to the Easy Investors listening. But back to you guys. So, you mentioned offshore stocks. You both have mentioned offshore stocks. You both love offshore stocks from what I know about you guys. And so what I was thinking was, does that also count towards good diversification, Barry?
Yes, definitely. Yeah, that is a good way for diversifying your portfolio, is definitely investing offshore. That's not necessary to say that there aren't any opportunities on the local market. But obviously, like anyone, if you were sitting in the States today and the US economy was tanking, you would take your money offshore as well, because there are better opportunities elsewhere at the moment. As things change, you bring back your cash and life is good. But yeah, offshore and diversification is, I would say nowadays, is kind of a must while we ride out the current economic headwinds that we're currently facing now. But yeah, I think it's a must, especially for newbies as well. Just consider it.
Nice. And Higgo, you love Tesla, which is offshore. Would you say you have a preference for, you do have a preference for, I'm guessing, international stocks, right? And why was that?
The reason for that is especially the US stocks. First of all, there's way more research out there that you can use. And like I said, I really like understanding completely what I invest in. So especially if it's a big portion of my portfolio. So there's, first of all, way more resources offshore. But that is something FinMeUp is also trying to change now, to do more in detailed research on JSE stocks. But also the US economy or the US companies are all international companies. So by investing some of the international companies listed on the US, you get global diversification. Where with the JSE stocks, there's not a lot of companies that provide you with complete international diversification. For example, a company like Prosus and Naspers, I love those companies, and I have invested quite a portion in Prosus, because they're phenomenal holdings right across the globe, and it just provides that diversification within one company. So where I don't have to go out and buy a share in China, a share in the UK, a share in the US, a share in South Africa. With a company like Prosus, I can buy Prosus, and I get diversification to all those companies. But I just believe there is opportunity in South Africa, a lot of opportunity, but there is definitely a lot of stuff that needs to be sorted out first, because before I'll look to invest most of my money here. But I have quite a few investments in South Africa, so I'm not completely pessimistic. I'm actually optimistic, and that is why we're focusing on South Africa as well. But I just believe there are a lot of opportunities across the world as well.
So it just reiterates that your point in doing your own research and trying to understand the business, you get lots more information from international companies, from what I understand. And also, I've noted that you've done a lot of Australian analysis for us at Easy Research. So are there things, what do you find attractive about the Australian market? And is there a specific company you're currently interested in or, that you like?
Yeah. So I think the Australian market is still a bit untapped. So I think there is a lot of opportunity. And I know EasyEquities is also launching there now, which would definitely increase the demand and higher the volumes in trades for Australian stocks, which is a good thing. But there are a few companies. So it's on EasyEquities. The Australian notes that I wrote, I'll continue to do so. Also on our stock picks. But there are a few companies that I really like. For example, Appen. I don't know if I pronounce it correctly. APPEN. They have a lot to do with artificial intelligence, and it's a great company, and they had a strong pullback lately, so it might be a good buying opportunity. Then there's another company called A2 Milk. I mean, who would have thought you'd invest in milk in Australia? I never thought that, but anyway, A2 Milk, they are starting to scale now globally as well, in China, in Australia, in New Zealand, so in the UK. So it's a milk company. Everybody's going to need milk the rest of their lives, even though some people are allergic to it or lactose intolerant, but they also make products for people that are lactose intolerant. So it's a great company starting to scale now. So there are a few companies, Next DC, that I also have notes on, Appen, A2 Milk. So there's a few. You should just go look and find some interest there.
Nice. And for you, Barry, personally, which offshore stocks are you kind of looking at?
Aussie stocks.
And just any, Aussie, US?
Yeah, I just want to say they suck at rugby, so hopefully their stock market is better. But no, yeah, actually in Aussie stocks that I'm interested in, there are quite a few, and especially small caps. Small caps are booming on that exchange. So I think our Easy investors go and check that out. But for me, yeah, I like the classics when I look at offshore. So it would be obviously Apple, Amazon, all these big tech names, which luckily for us, we can buy fractions in, because some of their prices are a bit ridiculous at some stage, or for some guys. But yeah, definitely look at the classics at the current moment. And yeah, that's kind of it in the US.
Nice. Okay, sweet. And I like that you both mentioned tech stocks. Is that like pretty much you guys have a positive overview of what tech is doing in the world? Is that why, Barry, you find tech stocks most interesting?
Yes, definitely tech is the flavor of the decade currently. So at some point in time, that will change as well, like we've seen throughout the ages. I mean, 50, 100 years ago, industrial age was booming, and then it was just industrial stocks on every exchange were the flavor of the month. And this millennia will probably be tech stocks, and then that will go into renewable energy, who knows. But yeah, for now, definitely optimistic on tech. The world is moving towards tech and AI, so definitely a must-have in a portfolio, to my opinion. Yeah.
Higgo, your opinion on tech?
Yeah, I'm a very big tech fan. It's just because what happened this year, it just accelerated the whole movement to digitalization. So if you look at education now online, if you look at meetings like this online, webinars online, the way people work online from home, the way people communicate online, the way people shop online. So everything is becoming tech central, and I can't see this going away anytime soon, as it is just so. First of all, it's experience. If you shop online, it's cool. It's like I shopped online, and it's convenient. So I can't see we going back to just going to malls the entire time. And I definitely think the technology space will continue to increase, and that's why the tech stocks had such a great run already. But I definitely think there's more room for growth in the tech space.
Nice, sweet. Gents, you guys answered like pretty much all of my questions. So now I'm just going to take it to the floor and go to the Q&A section and ask for some more of the questions that our community has asked. So one of them is from Benji. Benji is asking, what are the benefits of investing in individual stocks or creating your own portfolio versus putting your money into a fund management company? And I'm going to give this to Higgo. So it's pretty much
Sure.
versus with a fund.
Yeah, sure. So definitely something I want to see in the future more and more of, and I think that's why what EasyEquities as well as Fin Me Up are doing right now is my vision is almost that in the future everybody will just manage their own assets, their own platforms, which is not a good thing for asset managers, but a good thing for a platform like EasyEquities. But I want people to be able to understand what they are doing and do it well. So there's definitely room for that. And if you invest in an ETF, for example, you can still do it yourself with saving, and you're saving a lot of fees. You're saving a lot of transaction fees or commission fees. So if you don't really want to invest in individual stocks, invest in an ETF. But the benefits of investing in individual stocks is that you are risking a bit more than investing in an ETF. But I mean, the higher the risk, the higher the reward. And with over diversification, like I said, you can lower those returns. You're going to struggle to understand the companies. But if you know how to understand companies, if you know how to do your research, and then you can invest in individual stocks. You can't go wrong with either way, ETFs or stocks. The biggest risk is not investing, in my opinion, because I treat personally, I like to think of the theme and the way I use my money. I treat every cent that I own like an employee. So the work of an employee in your company is to grow your company or to make more money for you. And that is what I want to do with every cent I own. How is this cent going to make more money for me in the future? And then I put it to work. But if it's just in cash, inflation is going to beat the cash or the bank returns that they give you for interest. So personally, I favor investing in personal or in individual stocks because I can do a lot of research and I have a lot of time for it, and it's my passion, and I learned through the years. But you learn through mistakes and also through successes. But ETFs is also a good investment, but I personally choose individual stocks.
Nice. Okay, sweet. Thank you. And for Barry, I'm going to throw you a nice one here about gold since you touched on it before. Kotlana asked a long message, but I'm going to whittle it down. And he's asking pretty much, how would you suggest is the best way to invest in the new age gold rush? So pretty much they want to invest in commodities and they just want to understand what opportunities are out there for people looking into gold.
Okay, yeah, so definitely within the gold space, gold is starting to stabilize at the current moment after that rush that we saw within the commodity itself. But a good place to go and look for opportunity within that commodity space would be gold stocks listed on the JSE. So you'll look at your typical Sibanye gold, or it's now Sibanye Stillwater. You'll go and look at that and all the other tech stocks. The other gold stocks available to you on the Easy platform. That would be definitely the first place that you would kick off your journey. So then you'll go and look at, okay, great, what did these companies do over the last 3 months when gold was spiking? Was there good returns? What are the future growth prospects of these companies? And then you start your whole process, analyze the company, make a decision, and then you start buying. So that would be a good place to start for the new guys. But buying ETFs, ETNs at this stage, I don't think the newbie investor should get into that because that might be more difficult than just buying normal stocks. So I think a good place would be to start there.
Nice. Okay, cool. That makes a lot of sense. And I see someone here saying ETFs is king on TFSA. We'll be discussing that next week. We'll go into ETFs a lot more next week with Sean Keeling. So just please join that webinar as well. It's at 2 o'clock until 3. So yeah, I look forward to that. And so people are now asking about ETFs a lot, actually. And they're just pretty much asking, they're pretty much just asking about ETFs and why you would look to investing in ETFs in the long term. And I just want to say, because like we had mentioned before, it's all about diversification, and it's sort of simpler. There's less research you have to do, and it's done by a financial institution. So a lot of the big minds that already understand the markets do the research for you. And then I also just want to answer this question about how you can access the recording. We will post it on our YouTube channel, and we'll share that with you on our social medias and by email as well. Cool. And so someone asked a unique question, and I don't know who I should ask to answer this one, but they asked, why is it that sometimes a share like Sasol, whenever there's bad news about Sasol, the stock picks up? How is that possible? So I think I'll give it to Barry again.
Yes.
Yeah, I'm all saying aye. Let's go for it. Yeah, so I don't necessarily think that's true. When there's bad news, the stock goes up. Stocks like Sasol, it's very obviously the company fundamentals have been very under the spotlight this last couple of months, mainly due to the oil price. So that's also another thing, is you can obviously look at what the oil price is doing and try and translate that back to Sasol, because obviously those two are very connected. So actually it's the other way around. So usually when you see the oil price start to tank, then you can expect a share like Sasol to also underperform over the short term. I mean, that's obviously the crux of the whole thing, is that stocks should go up and companies should grow. And so that would translate to a share price increasing over time. But yeah, Sasol, I'll definitely look at what the oil price is doing. Yeah, so I think the guy asking the question might have it the other way around.
Nice. And you also touched on market psychology, and people are asking, what is a great book? Can you recommend a book? I'll first ask you, Barry, then go to Higgo on investing.
I think we can post. I'll go and look for a couple of nice ones, and then we can share that with our viewers. But at this stage, there's not a single one that's jumping out at me. So yeah.
Cool. Higgo?
So Intelligent Investor is definitely a good book, but also two other books that I really like and I found very useful, but it's not to do with investing, it's more with startups. But I'm sure if you're an investor, you also enjoy entrepreneurship. Those two books are 0 to 1 from Peter Thiel. He's amazing. You can go check it out. And The Lean Startup. Those are three books: Intelligent Investor, The Lean Startup, and 0 to 1.
Oh, nice. Okay, sweet. And as well, then people are also asking, what is the worst investment advice you got, Higgo? The worst.
Sure. Invest in Steinhoff. No, I'm joking. Sure, that's a tricky question. There's nothing specifically that I'd say you ruined my investing career or something, but I've been privileged to have a lot of good mentors, which gave me great advice. But there's nothing I can think of specifically as bad advice. If I can think off the top of my head, something that would be bad is saying put all your money into shares that you love. That is just the risk of not diversifying. But then I'd also say, if someone tells me invest in 40 individual stocks yourself, I'd also say that's bad advice, because how can you understand 40 companies in and out and track the fundamentals? So that's what I'd say.
Nice. Barry, worst advice?
Thank goodness that I didn't take this advice. It was specifically towards Steinhoff. Steinhoff, very topical. And that was to buy more while the share price was tanking. Thank the Lord I didn't do that, because that was the worst advice that I've ever came across in my life. And unfortunately, a lot of market participants out there, their thought process is like that. They want to buy it at a cheaper price, and it's a good company, blah, 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 all the hoopla that was surrounding Steinhoff at the time. But yeah, definitely. I think for the easy investors and you guys out there, is make up your own mind. Like you said, go deep into those companies, understand what's going on. Don't just follow people blindly. Don't just buy a thing because it's cheap today. It might be cheaper tomorrow, or even bankrupt the next day. Who knows? So yeah, do your own research, follow your own head, come up with a system that you follow, that you trust, and definitely listen to what people are saying. And what has worked for me over the years is I listen to what people say around me, and 9 out of 10 times I do the opposite of what they're saying. And that has worked out very well for me. So yeah.
Cheap can always become cheaper.
Definitely.
Nice. And about that, I feel like we were speaking to the same person probably, because I got the same advice about starting off, and I actually bought it. So I'm really annoyed. So I feel you on that, man. It was the worst decision I've made, one of the worst ones. And then to wrap it up, sort of, on everything we've spoken about, I want to get from you, Barry, what are the top 3 things you consider before investing? And this is a question from Anonymous. So the top 3 things you consider. And I think we can go like holistic. We can either in a company, your own self, whichever. What are the top 3 things you think consider before? Ooh, Barry's connection.
Geez, that's quite broad, right?
Okay, let's start with the company then. What are the top 3 things you could consider in a company?
You know, it's days like these when I wish I was a hedge fund and I can just drive my service provider's share price into the ground. I mean, what's going on with this internet? No, I'm just kidding. I don't understand. Well, that's quite a broad question. Why not we do a 360 and ask you that question?
Cool. For me, the top 3 things I would consider is how much am I willing to lose or not gain? So if I'm investing in a company and it's not returning me anything or it's going down, how much of my own free cash, the savings, whatever that I've put aside, how much of that am I willing to not have back as it was before? That's the first thing. The second thing is, would I rather use this product or invest in the share? So I love Ray-Bans, but I don't think the business itself is anything that spectacular. And lastly, it's pretty much the fundamentals. My favorite also is a fundamental. So for instance, where are they headed? And what does their, I want to get technical, but the debt to ratio is something that I actually like looking at as well. So yeah, so those are the things I consider. Higgo, do you have?
Yeah, I'd say, so there's so many aspects that you can ask this question, but when it comes to a specific company and whether I want to invest in the company, I'd look at the present, the past, and the future. So what have they done? What track record do they have? Where are they now and where they're heading? Then I look at the sector. Do I think this industry or sector has a future? Will it grow over the next few years? And then my last question is, will I back the management to make this a success? I'd say those are the 3 biggest aspects, and try to understand consumer behavior as best as I can. For example, with Purple Group, I tweeted yesterday, the volatility in the markets is a good thing for a company like Purple Group and Robinhood, because people are panicking buying, panicking selling, trading, and the volumes go up. So that's an example of consumer behavior. So yeah, I'd say those are the most important aspects.
Sweet. And that's our hour, guys.
What's that?
So I'd like to thank Higgo, CEO and founder of FinMeUp, the app, the financial education app, and Barry Dumas, my colleague and friend at Easy Research and GT247. Thank you all for tuning in, guys. This has been a very insightful webinar for me, and I hope it's as insightful for you. So thanks for tuning in, and cheers, everyone.
Awesome.
Guys, thanks, man.
Bye.
Bye.